I think all focus of the currency market today really on the European Central Bank. It's expected to make a rates decision early this afternoon, of course, have that press conference, and looks like the market pretty much pricing in no rate hike this time around.
Yeah, good morning, Stephen. I don't think we're going to get any change today, but the market is kind of positioning itself now for a potential hike at the July meeting. And of course, that press conference will give us a little bit more colour as to the ECB's current thinking on inflation. Inflation is trending higher across the globe. We know that with energy and food prices kind of leading the charge. And of course, central bankers will be concerned, as would the Reserve Bank, of the kind of second round inflationary implications that could be in the offing down the line with those higher oil prices and higher food prices obviously filtering through into consumers' daily spend.
Of course, the ECB, unlike the Fed, doesn't have a growth mandate, and growth really is at the forefront of concerns over the past couple of weeks. So we had the Fed's Beige Book yesterday, we had Ben Bernanke speaking on Tuesday and really highlighting the slowdown in growth we're seeing at the moment.
Yeah, absolutely, Stephen. I think the global growth outlook is looking a lot more dismal than what we were hoping for. And, you know, obviously last week we saw that flurry of weak data. And you know, these higher oil prices are certainly not helping. In fact, higher oil prices can almost be regarded as some kind of interest rate hike by themselves. And yesterday we didn't see OPEC really come into the party and increase in production output. And that's despite the fact that we've had obviously a withdrawal out of the Libyan region due to those geopolitical tensions. So energy prices at elevated levels, and that's constraining demand, it's constraining the global recovery. And whilst the ECB doesn't have to specifically monitor that, of course central banks have to be mindful that they can't be too quick to hike rates aggressively, because we're still in the throes of this economic recovery, and we want this economic recovery to be sustainable. We don't want any kind of double dip slowdowns occurring. And I think the fears of those double dip scenarios are definitely being reflected in the global equity markets, and possibly a reason why people are a bit reluctant to buy risky assets. I think we're in a holding pattern now in terms of risky assets. We're watching very closely to see what this global growth outlook actually has in store for us.
How's this all being reflected in currency movements, Michael? Because we've got the rand still trading around 672, 673, so right where it was when we chatted to Standard Bank yesterday morning. Do you think we're going to see any movement depending on the wording of that ECB statement?
Look, there's no doubt that dollar rand is tracking euro dollar extremely closely, but I think you bang on, Stephen. You know, we are really very much in the throes of a fairly tight range. 66.82 is the short-term range. The medium-term range is kind of 6.55 right up to kind of the 7 rand handle. And you know, I think we're not going anywhere fast really, because participants, as I said just now, are a little bit uncertain as to, you know, sure there's a lot of cheap money still out there. The Fed is going to remain accommodative for the foreseeable future. But what about the global growth prognosis? Is that going to inevitably translate into some kind of demand destruction within the commodity markets? Is it inevitably going to translate into a slower growth in exports out of emerging markets? And possibly, if that is actually the case, then we could see a pullback in some of these emerging markets, which have obviously been benefiting from this glut of liquidity and this chase for yield and chase for growth over the past 18 months.
How about the South African growth picture? Because we had those first quarter growth numbers at beginning of last week, 4.8%, better than expected, driven by the manufacturing sector, which rose by 14.5%. Now, we are getting manufacturing production numbers for April out today. In March, we had 4.6% rise. Are we going to have maintained that momentum we built in that manufacturing sector?
I doubt it, Stephen. I think we're going to see a pullback in the manufacturing figures today. I think we only got to look at the Investec PMI reading to see that the manufacturing sector started to pull back again in more recent months. We had a very strong first quarter, as you mentioned, but I think we're probably going to see a bit of cooling down in the local manufacturing sector. And of course, that doesn't bode well for GDP growth, because, you know, manufacturing is a huge constituent of the overall GDP figure. So I think this number is something to watch quite closely, because as we discussed already, a lot of focus at the moment is on growth and the recovery and the sustainability of the respective economic recoveries within countries. So I think we've got to keep a close eye. I think the number will come off, but I don't think it's going to fall off a cliff. That's not what the PMI readings suggested. So I think we will see a moderation, but it won't be sort of cataclysmic.